Hello and welcome. Over the next several chapters, we are going to embark on a journey to understand one of the most talked about technologies of our time, blockchain. You've likely heard the term mentioned alongside cryptocurrencies like Bitcoin, or in discussions about the future of finance, data security, and the internet itself. But what is it really? How does it work? And why do some people believe it has the power to change our world? This series is designed to answer those questions from a clear, educational perspective, specifically for our audience in the United States. Our goal is not to tell you what to think, but to provide you with the foundational knowledge to understand the technology and the conversations surrounding it.
The information presented in this video is for informational and educational purposes only, and is not professional financial, investment, or tax advice. All cryptocurrency investments involve risk, and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. Cryptocurrency investments are highly volatile and speculative. This video does not recommend investing in any specific cryptocurrency. Always do your own research and assess the risks before making any investment decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
Imagine a group of people who want to keep a shared record of important information. Let's say it's a record of transactions. In the traditional world, they might appoint one person, a treasurer, to manage a central ledger, a single notebook where all transactions are written down. Everyone has to trust that the treasurer is honest, that they won't make mistakes, and that the notebook itself is safe from being lost, stolen, or altered. This creates a central point of failure. If something happens to the treasurer, or that one notebook, the entire system is compromised. Blockchain technology offers a radical new approach to this age-old problem of trust. Instead of one person holding one notebook, imagine that every single person in the group gets an identical copy of the same notebook. When a new transaction occurs, it's announced to the entire group. Everyone then checks their own copy of the notebook to make sure the transaction is valid. For instance, they check if the person sending money actually has the funds to send. Once the majority of the group agrees that the transaction is legitimate, everyone records it on a new page in their own notebook. This new page is then cryptographically sealed and linked to the previous page. This is the core idea. Let's break down the name, blockchain. It's a chain of blocks. The block is like a page in our magic notebook. It contains a list of recent, verified transactions. It also contains two other important pieces of information: a reference to the block that came before it, and a unique code, like a digital fingerprint, called a hash. The chain is what makes the system so secure. Each new block's unique fingerprint, its hash, is mathematically created using the data inside it, and the hash of the block that came before it. This means that each block is permanently linked to the one before it, creating a chronological and unbreakable chain. If someone wanted to go back and secretly change a transaction on an old page, an old block, they would have to do more than just alter that one block. Changing the data in the block would change its unique hash. Because the next block in the chain contains the hash of the one before it, that next block would now be invalid. Its link would be broken. To make the chain valid again, the manipulator would have to recalculate the hash for that block, and the next one, and the one after that, all the way to the very end of the chain. But remember, this isn't just one notebook. Everyone in the network has a copy. So the manipulator would have to perform this impossibly complex calculation on more than half of all the computers in the network, all at the same time, before the next legitimate block is added. For any reasonably sized network, this is considered practically impossible. This feature is called immutability. It means that once data is recorded on a blockchain, it cannot be altered or deleted. It's there forever, for all to see. This brings us to the three core pillars of blockchain technology: decentralization, immutability, and transparency. First, decentralization. As we discussed, there is no central authority. The ledger, or database, is distributed across numerous computers in a peer-to-peer network. No single person, company, or government owns it or controls it. This removes the need for a trusted middleman, like a bank, to verify transactions. The network itself establishes trust through consensus. Second, immutability. As we just covered, the cryptographic linking of blocks makes the data tamper-proof. The history of transactions is preserved in a way that cannot be rewritten, creating a level of integrity that is difficult to achieve in traditional centralized systems. And third, transparency. While the identity of participants can be pseudonymous, the transactions themselves are typically visible to everyone in the network. Anyone can look at the ledger and verify the history of transactions. This creates a system where all actions are auditable, fostering an environment of trust through shared visibility. It was the combination of these three principles that made Bitcoin, the first ever cryptocurrency, possible back in 2009. It allowed for a secure, peer-to-peer electronic cash system to exist without any bank or financial institution in the middle. However, and this is a key takeaway from our first chapter, blockchain technology is much, much bigger than just Bitcoin or cryptocurrencies. It is a foundational technology for creating trust and agreement in a digital world. Think of it as a new kind of operating system for trust. Its applications are being explored in countless industries. For example, in supply chain management, it can be used to track goods from the factory to the store shelf, ensuring authenticity and preventing fraud. In healthcare, it could be used to create secure and portable health records that patients control. In voting systems, it could ensure a transparent and tamper-proof election process. We are still in the very early days of this technology, much like the internet in the mid-1990s. There are challenges to overcome, including scalability, energy consumption, and regulatory questions. But the fundamental concept of a decentralized, immutable, and transparent ledger presents a powerful new tool for how we organize and verify information. In this chapter, we've laid the groundwork. We've defined what a blockchain is through an analogy, broken down its name, and understood its three core pillars: decentralization, immutability, and transparency. Most importantly, we've established that this is a technology with potential far beyond its initial application. As we move forward in this series, we will build upon this foundation. In our next chapter, we will take a closer look at the mechanics. We'll explore exactly what happens when you initiate a transaction, how new blocks are actually created in a process called mining, and the role of consensus mechanisms in making sure everyone's copy of the ledger stays in sync. Thank you for joining me for this introduction. I look forward to exploring the next layer of this fascinating technology with you in Chapter 2. Welcome back. In our first chapter, we introduced the big picture of blockchain technology, using the analogy of a shared, magic notebook to understand its core principles: decentralization, immutability, and transparency. We established that a blockchain is a secure, distributed chain of blocks. But how does information actually get into one of those blocks? What happens step by step when you send or receive data on a blockchain? That's our focus for today. We're going to dissect the life cycle of a transaction. And remember, while we might use examples related to digital currencies because they are a common application, the process we're describing is fundamental to how most blockchains work, whether they're moving currency, tracking medical data, or verifying the origin of a product. As always, a quick reminder: this content is for educational and informational purposes only. It is not financial, legal, or any other form of professional advice. Our goal is to understand the mechanics of the technology, not to advise on its use. Always consult with a licensed professional for any financial or legal questions. Let's start with the moment a transaction is born. Imagine Alice wants to send 1 unit of a digital asset to Bob. The first thing she does is use her digital wallet to broadcast a message to the entire network. This message contains 3 key pieces of information: Bob's address, the destination, the amount she wants to send, and her digital signature. Let's pause on that term, digital signature. This is one of the most important cryptographic concepts in blockchain. It's what proves ownership and authorizes the transaction. It works using something called public key cryptography, which involves a matched pair of keys: a private key and a public key. Think of the public key as your bank account number. You can share it with anyone who wants to send you funds. It's publicly visible. In the blockchain world, your public key is the basis for your wallet address. The private key, on the other hand, is like the secret PIN or the password to your bank account. It is something you must never share with anyone. It is kept secret and is used to authorize or sign transactions you want to send from your account. When Alice initiates the transaction, her wallet software uses her private key to create a unique digital signature for that specific transaction. This signature is mathematical proof that the owner of the private key, and therefore the owner of the funds, has approved this specific action. The beauty of this system is that the network can use her public key to verify that the signature is valid without ever seeing her private key. This ensures both security and authenticity. So, Alice has broadcasted her signed transaction. What happens next? Her transaction doesn't go directly onto the blockchain. First, it goes into a waiting area, often called the mempool, which stands for memory pool. The mempool is essentially a giant, collective waiting room for all the unconfirmed transactions happening across the network. Thousands of other transactions from users all over the world are also sitting in this pool, waiting to be processed. This is where the concept of miners, or in some newer systems, validators, comes in. These are the participants on the network who do the work of gathering the transactions from the mempool and assembling them into a new block. Think of them as the scribes for our magic notebook, whose job is to collect all the new entries and prepare to write them on a new page. A miner will select a group of transactions from the mempool. Often, they prioritize transactions that include a higher transaction fee, which is a small amount the sender, like Alice, can choose to include as an incentive for the miners. The miner then gathers these transactions into a candidate block. But just assembling the block isn't enough. To add their block to the official chain, the miner must first solve a complex mathematical puzzle. This process is known as proof of work, POW. It is the most well-known, and the original consensus mechanism, famously used by Bitcoin. The term proof of work sounds complicated, but the idea is straightforward. The miner's computer has to perform an incredible number of rapid-fire guesses to find a specific number, called a nonce. When this nonce is combined with all the other data in the block and put through a hashing algorithm, the result must be a hash that meets a certain, difficult target. It's like trying to find the one winning lottery ticket out of billions, and the only way to find it is to buy and check every single ticket, one by one at lightning speed. This work requires an immense amount of computational power and electricity, which is a primary criticism of proof-of-work systems. But it serves a critical purpose. It makes it incredibly difficult and expensive to add a block to the chain. This difficulty is what secures the network. To add a fraudulent block, a bad actor would need to solve the puzzle faster than anyone else, which would require an astronomical amount of computing power. The first miner to solve the puzzle earns the right to add their block to the blockchain. They broadcast their solution and their completed block to the entire network. The other nodes or participants on the network then quickly check the work. They verify that the miner's solution to the puzzle is correct, and that all the transactions within the block are valid according to the ledger's history. This verification process is very fast and easy, even though the initial work was very hard. Once a consensus is reached and the new block is accepted by the majority of the network, it is officially attached to the end of the chain. Every node updates their copy of the ledger with this new block. At this moment, Alice's transaction for Bob is officially confirmed. It is now a permanent, immutable part of the blockchain's history. The transfer of value is complete. For successfully doing this work, the miner is rewarded with a certain amount of newly created digital currency and the transaction fees from the block they built. This reward is the economic incentive that keeps miners participating and securing the network. It's important to note that proof of work is not the only method for reaching consensus. Newer blockchains often use a different system called proof of stake, POS. In a proof of stake system, instead of miners competing to solve a puzzle, validators are chosen to create new blocks based on the number of coins they hold and are willing to stake as collateral. We will explore proof of stake and other consensus mechanisms in greater detail in a future chapter, as they represent a significant evolution in the technology. So let's recap the journey. A transaction is created and signed with a private key. It is broadcast to the network and enters the mempool. A miner selects it and includes it in a candidate block. The miner performs the proof of work, solving a puzzle to earn the right to add the block. The solution is verified by the rest of the network. And finally, the new block is added to the chain, permanently confirming the transaction. Understanding this flow is key to grasping how a blockchain functions as a system of trust without a central authority. The trust isn't placed in a person or an institution. It's placed in the cryptographic proofs and the economic incentives that bind the entire system together. In our next chapter, we will delve deeper into the structure of the blockchain itself. We'll look at what a distributed ledger truly means, explore the difference between public and private blockchains, and discuss how this technology is governed. Thank you for joining me. Hello and welcome back. In our previous chapter, we followed the journey of a single transaction, from a click in a digital wallet to its permanent place on the blockchain. We learned about digital signatures, the mempool, and the process of proof of work. Now we're going to zoom out and look at the bigger picture, the ledger itself. What does it really mean for a ledger to be distributed? And are all blockchains created equal? As we begin, please remember our guiding principle for this series. The information provided is for educational and informational purposes only. We are exploring the technology, not offering any form of financial, investment, legal, or tax advice. For any such matters, it is crucial to consult with a qualified and licensed professional. Our mission here is to build knowledge, one block at a time. The distributed ledger in focus. We've used the term distributed ledger several times. Let's fully unpack that concept. In the traditional world, databases are centralized. Think of a bank's customer database or a government's record-keeping system. The data is stored on a central server, or a group of servers, owned and controlled by a single entity. That entity has ultimate authority over the database. They can update it, change it, and grant or deny access to it. A distributed ledger, the foundation of a blockchain, is fundamentally different. Instead of one central copy, the ledger is replicated and spread across many different computers, in many different locations. Each computer in the network is called a node, and each node maintains its own identical copy of the entire ledger. When a new block of transactions is verified and added to the chain, it's not added to a central server. Instead, it is broadcast across the network, and every single node updates its local copy of the ledger. This architecture is what gives a blockchain its resilience. There is no single point of failure. If one node goes offline or is compromised, the network continues to run uninterrupted because thousands of other nodes still have the correct, verified copy of the history. This system design inherently creates a robust and censorship-resistant database. No single person or group can unilaterally decide to delete a record or block a transaction, because to do so, they would need to control a majority of the nodes on the network, a feat that is practically impossible on a large public blockchain. Types of blockchains. It's not a one-size-fits-all technology. So far, our examples have mostly described a specific type of blockchain, the kind that is open for anyone to join and participate in, like Bitcoin or Ethereum. This is known as a public blockchain. Public blockchains are completely permissionless. This means anyone, anywhere in the world, can download the software, run a node on their computer, and start participating in the network. Anyone can view the ledger, send transactions, and if they have the necessary hardware, participate in the consensus process, like mining. They are the epitome of decentralization and transparency. Because they are open to all, they are secured by cryptographic and economic incentives, the proof of work or proof of stake mechanisms we've discussed, to ensure everyone plays by the rules. But what if an organization wants to use blockchain technology for its own internal purposes? What if a group of companies wants to share data securely, but not with the entire world? For these use cases, public blockchains are not always the ideal solution. This has led to the development of other types of blockchains. A private blockchain is the opposite of a public one. It is permissioned, meaning you need an invitation to join. A central administrator or a group of administrators determines who can participate in the network, who can view the ledger, and who can submit transactions. Because participation is tightly controlled, these blockchains don't necessarily need a robust consensus mechanism like proof of work. The trust is handled by the contracts and agreements between the participants, not by a computationally expensive algorithm. Think of it like the open internet versus a company's internal intranet. A private blockchain is like an intranet. It's highly efficient and secure for internal record keeping, but it is centralized. A single entity ultimately controls the rules. This makes it a great tool for businesses looking to improve internal processes, like a corporation tracking its internal assets or managing its supply chain data between departments. There is also a hybrid model that sits between these two extremes, called a consortium blockchain, sometimes known as a federated blockchain. In this model, the blockchain is governed by a pre-selected group of organizations, not a single entity. Imagine a group of major banks that want to create a more efficient system for clearing and settling transactions between themselves. They could form a consortium and run a blockchain where each bank operates a node. The rules of the network are decided by the group. It's more decentralized than a private blockchain because control is spread across several organizations, but it's not fully open to the public like a public blockchain. Consortium blockchains are often seen as a promising solution for collaboration within industries, offering a shared, trusted source of truth without sacrificing the privacy and control that businesses require. Who makes the rules? A glimpse into governance. This discussion of different blockchain types leads to a final, crucial question. Who makes the rules? In a private or consortium blockchain, the answer is straightforward: the owners or the members of the consortium. But in a decentralized public blockchain, it's far more complex. The rules of the network are embedded in its software protocol. What happens if the community wants to update those rules or fix a bug? This process is known as blockchain governance. It's a system for managing and implementing changes to the protocol. This can involve developers proposing changes, miners and nodes voting on whether to accept them, and sometimes, intense community debate. It's a fascinating and evolving field that mixes technology with human coordination and politics, and it's a key challenge for the long-term viability of decentralized networks. To summarize today's chapter, we learned that a distributed ledger is a replicated, shared database with no central point of failure. We discovered that blockchains are not all the same. Public blockchains are open and permissionless, private blockchains are controlled by a single entity, and consortium blockchains are governed by a group. Each type has distinct advantages depending on the desired balance between decentralization, privacy, and efficiency. In our next chapter, we will move beyond the basics of transactions and blocks to explore the concept of smart contracts. This is where blockchain evolves from a simple, secure ledger for data into a global, programmable computer. Thank you for joining this session. I look forward to seeing you in Chapter 4. Welcome back to our series on blockchain technology. In our journey so far, we have established what a blockchain is, how transactions are added to it, and the different types of ledgers that exist. We've seen how a blockchain can act as a secure and immutable database for recording information. But what if a blockchain could do more than just store information? What if it could act on that information automatically? This is where the technology takes a giant leap forward, with the introduction of smart contracts. Before we explore this powerful concept, let's reaffirm our commitment to education. This chapter, like all others in this series, is for informational purposes only. It does not constitute financial, legal, investment, or any other form of professional advice. The examples we discuss are purely illustrative to help explain the technology. For any decisions related to finance or law, please consult with a licensed and qualified professional. So what exactly is a smart contract? The name can be a little misleading. It's not a contract, in the traditional legal sense, and it's not smart, in the way a human is. A better way to think of it is as a programmable agreement or a self-executing script that lives on the blockchain. Let's use a simple, everyday analogy, a vending machine. When you use a vending machine, you are entering into a simple agreement. The machine's glass door displays the terms. If you insert a certain amount of money, and you press a specific code, then the machine will release the corresponding item to you. There's no need for a cashier, no negotiation, and no intermediary. The terms are programmed directly into the machine. The process is automatic and guaranteed. You put in the money, you get your snack. The machine doesn't need to trust you, and you don't need to trust the machine's owner. You trust the code that runs the machine. A smart contract operates on a similar principle. It is a piece of computer code that is stored on a blockchain. This code contains a set of rules and conditions. The most fundamental logic of a smart contract is if-then. If a specific, predetermined condition is met, then the contract automatically executes a certain action. Because this code lives on the blockchain, it inherits all the properties we've discussed before. It is decentralized, meaning it runs on all the nodes of the network, not on a central server. It is immutable, meaning that once the contract is deployed on the blockchain, its code cannot be changed or tampered with. And it is transparent, as anyone with access to the blockchain can view the logic of the contract. This combination of automation and blockchain-based security is what makes smart contracts so revolutionary. They allow for the creation of trustless agreements. The trust is not in a person or a company, but in the code itself, which will execute exactly as written, every single time. This idea transforms the blockchain from a simple distributed database into something more akin to a global, decentralized computer. It becomes a platform on which developers can build applications, often called dApps, or decentralized applications. Let's walk through a hypothetical, non-financial example to make this clearer. Imagine a freelance graphic designer, Jane, who is hired by a company, Innovate Corp, to design a new logo. In the traditional world, this involves trust. Jane has to trust that Innovate Corp will pay her after she delivers the logo. Innovate Corp has to trust that Jane will deliver the work after being paid. This often requires invoices, payment processors, and potential legal follow-up if one party doesn't hold up their end of the deal. Now, let's see how a smart contract could streamline this. Jane and Innovate Corp could agree to the terms and deploy a smart contract on a blockchain. The logic of the contract would be simple. The contract holds the payment from Innovate Corp in a secure, locked state, a digital escrow. The if condition is Jane uploading the final logo file to a specific, verifiable digital location. The then action is the automatic release of the funds from the contract to Jane's digital wallet. Once the contract is deployed, it runs itself. When Jane uploads the logo, the contract can automatically verify this action has occurred. As soon as the condition is met, the payment is executed. There is no delay, no need for an invoice, and no possibility of Innovate Corp refusing to pay after receiving the work. The agreement is enforced by the code. This is just a simple example. The potential applications of this if-then logic are vast and are being explored across numerous industries. In supply chain management, a smart contract could automatically release payment to a farmer once a shipment of goods is confirmed as delivered and signed for at a warehouse, verified by an IoT sensor. In the insurance industry, a flight delay insurance policy could be written as a smart contract. If a public flight data feed reports that your flight is delayed by more than 2 hours, the contract could automatically trigger and execute your insurance payout, without you needing to file a claim. In intellectual property, an artist could use a smart contract to automatically manage royalties. If a song is streamed or a digital art piece is used, the contract could automatically route a micropayment back to the original creator. It is important to understand that smart contracts are not a perfect solution for every problem. They have limitations. Their logic is literal. A smart contract will do exactly what it is coded to do, even if the coder made a mistake. This means that bugs or vulnerabilities in the code can have serious consequences, and because the contracts are immutable, fixing them can be incredibly difficult. The security and accuracy of the code is paramount. Furthermore, for a smart contract to interact with the real world, like verifying a package delivery or a flight delay, it needs a reliable source of external data. These data feeds are called oracles, and ensuring they are secure and trustworthy is a significant challenge in itself. In summary, smart contracts represent a major evolution of blockchain technology. They are self-executing scripts that run on a decentralized network, enforcing agreements automatically based on pre-written, if-then logic. They enable the creation of trustless systems that are transparent and tamper-proof, potentially streamlining processes in many different fields. In our next chapter, we will discuss one of the most well-known applications of smart contracts, non-fungible tokens or NFTs. We will explore what they are, how they work, and why they have captured so much public attention. Thank you for joining me. I look forward to our next discussion. Hello and welcome back. In our last chapter, we made a significant leap from viewing blockchain as a simple ledger to understanding it as a programmable platform, thanks to smart contracts. We learned that these self-executing scripts can automate agreements based on if-then logic. Today we're going to explore one of the most visible and widely discussed applications of smart contract technology, the non-fungible token, or NFT. You have almost certainly heard of NFTs, often in the context of digital art, collectibles, and headline-making sales. But our goal today is to look past the hype and understand the underlying technology. What are they, how do they work, and what problems are they designed to solve? As we proceed, we will continue to uphold our core principle. This content is for educational and informational purposes only. We are not providing financial advice, investment recommendations, or legal guidance. The world of digital assets is volatile and complex. Always conduct your own research and consult with licensed professionals for personal advice. Our focus remains solely on the technology, fungible versus non-fungible, the key to understanding. To understand a non-fungible token, we first have to understand the word fungible. Fungibility is an economic term that describes an item's ability to be interchanged with another identical item. Think about a $1 bill in your wallet. If you and I were to swap $1 bills, we would both still have $1. My dollar is not unique. It has the exact same value and utility as your dollar. They are mutually interchangeable. The same is true for a gallon of regular gasoline, a share of a company's common stock, or a single Bitcoin. One Bitcoin is interchangeable with any other Bitcoin. These items are fungible. Now, think about the opposite. Think about the original Mona Lisa painting hanging in the Louvre. It is one of a kind. You could not swap it for a print from the museum gift shop and still have the same item. Think about the deed to your house, or a ticket to a specific concert for a specific seat on a specific night. These items are unique, distinguishable, and not interchangeable. They are non-fungible. A non-fungible token, therefore, is a digital token that represents ownership of a unique item. It's a one-of-a-kind digital certificate of authenticity and ownership that is recorded on a blockchain. How do NFTs actually work? This is where smart contracts come back into play. An NFT is not the image, song, or video file itself. Instead, the NFT is a unique token that is created, or minted, by a smart contract on a blockchain.
The information presented in this video is for informational and educational purposes only, and is not professional financial, investment, or tax advice. All cryptocurrency investments involve risk, and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. Cryptocurrency investments are highly volatile and speculative. This video does not recommend investing in any specific cryptocurrency. Always do your own research and assess the risks before making any investment decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
This smart contract stores the token's essential information, which is often referred to as its metadata. This metadata typically includes a unique token ID, like a digital serial number, a link pointing to the actual asset it represents, like an image or a video file, which is usually stored elsewhere, the creator's wallet address, a history of every wallet address that has ever owned that specific token. Because the NFT exists on the blockchain, its ownership is secured by the same principles we've already discussed. It is transparent. Anyone can look up the token on the blockchain and see who created it, and its entire ownership history. This history is called provenance. It is immutable. Once the record of ownership is written to the blockchain, it cannot be altered or counterfeited. And it is decentralized, meaning you don't need a central authority like an auction house or a gallery to verify its authenticity. The network itself does that. So when someone says they bought an NFT, what they have really acquired is the unique token on the blockchain that serves as the verifiable, publicly auditable proof that they are the current owner of the asset it represents. Use cases: more than just digital art. While digital art has been the most popular use case for NFTs, the underlying technology has far broader potential applications. The core function of an NFT is to prove ownership of something unique. Gaming. In many online games, players buy items like special armor, character skins, or weapons. Traditionally, these items exist only within the game's centralized server. With NFTs, a player could truly own their in-game items. A rare sword could be an NFT, meaning the player owns it in their personal digital wallet, and could potentially sell it or even use it in other compatible games in the future. Event ticketing. Fake tickets are a major problem for live events. An event organizer could issue tickets as NFTs. Each ticket would be unique and its history would be traceable on the blockchain, making it nearly impossible to counterfeit. The smart contract could even be programmed to manage royalties, so if the ticket is resold, a percentage of the resale price could automatically go back to the original artist or venue. Certifications and credentials. Imagine your university diploma or a professional license was issued as an NFT. It would be stored in your digital wallet, be instantly verifiable by any potential employer, and would be impossible to forge. This could apply to any important record, from birth certificates to medical credentials. Real-world assets. The concept of tokenizing physical items is also being explored. In theory, the deed to a house or the title to a car could be represented by an NFT. This could potentially simplify the complex and paper-heavy process of transferring ownership of major assets, making it more secure and transparent. It is important to acknowledge the criticisms and challenges facing NFTs. Discussions around the environmental impact of the proof-of-work blockchains they are often built on are significant. Additionally, the space is new and has seen a high degree of speculation. These are hurdles that the industry is actively working to address with new technologies and standards. In summary, an NFT is a unique digital token, powered by a smart contract, that acts as a verifiable certificate of ownership on a blockchain. While popularized by digital art, its fundamental ability to prove ownership of unique assets, both digital and physical, gives it a wide range of potential applications. In our next chapter, we will dive into another major area of blockchain innovation: decentralized finance, or DeFi. We will explore how smart contracts are being used to build an alternative financial system on the blockchain. Thank you for joining me for this exploration of NFTs. I look forward to our next session. Hello and welcome back. In our journey through the world of blockchain, we have explored the foundational ledger, the mechanics of a transaction, and the power of smart contracts and NFTs. Today, we delve into one of the most ambitious and complex applications of this technology: decentralized finance, more commonly known as DeFi. This chapter will serve as a high-level introduction to what DeFi is and the concepts that drive it. As we venture into a topic that includes the word finance, our standing reminder is more important than ever. This content is for educational and informational purposes exclusively. It is not, and should not be interpreted as financial advice, investment advice, or a recommendation to use any specific product or platform. The DeFi space is emergent, experimental, and carries significant risks. Our objective here is purely to understand the technological framework, not to guide any financial decisions. For that, you must consult a licensed professional. What is decentralized finance, DeFi? To understand DeFi, it helps to first look at the system it is often contrasted with, traditional finance or TradFi. The world of TradFi is built on intermediaries. Banks, brokerage firms, insurance companies, and stock exchanges act as trusted central authorities that facilitate financial activity. They hold custody of assets, process transactions, and provide the infrastructure for everything from a simple savings account to a complex derivative trade. This system works, but it can be slow, expensive due to the layers of middlemen, and often exclusive, with barriers to access for many people around the world. DeFi proposes a different approach. It is an umbrella term for a growing ecosystem of financial applications that are built on top of public blockchains. The core idea of DeFi is to reconstruct these traditional financial services in a decentralized way, using smart contracts as the backbone. Instead of a bank, you have a smart contract. Instead of a stock exchange, you have a smart contract. The goal is to replace the need for trusted intermediaries with transparent, automated, and open-source code that runs on the blockchain. In a DeFi world, you and only you have full control and custody over your digital assets, interacting directly with the smart contracts from your personal digital wallet. The core components of DeFi. DeFi applications are often described as money Legos because they are designed to be composable, meaning they can easily plug into and build upon one another. Let's look at a few foundational pillars of the DeFi ecosystem in a purely conceptual way. 1. Decentralized exchanges, DEXs. In traditional finance, if you want to trade one asset for another, like swapping US dollars for euros or trading a company's stock, you go through a centralized exchange. A DEX aims to perform this function without a central operator. Many DEXs use a mechanism called an automated market maker, or AMM. Instead of matching individual buyers and sellers in an order book, an AMM uses smart contracts to create pools of assets. Users, known as liquidity providers, can deposit a pair of assets into a pool. The smart contract then uses a mathematical formula to determine the price of the assets in that pool based on their ratio. Traders can then swap one asset for another directly with the pool. The entire process is automated by the code, allowing for peer-to-contract trading rather than peer-to-peer. 2. Lending and borrowing protocols. Another core function of traditional finance is lending and borrowing. DeFi protocols replicate this using smart contracts to automate the process. Users can supply their digital assets to a lending pool and, in return, receive a yield that is algorithmically determined. Others can then borrow from this pool, but they must first provide collateral, typically in the form of other digital assets. The smart contract manages everything. It sets the rates based on supply and demand within the pool, holds the borrower's collateral, and if the value of the collateral falls below a certain threshold, the contract will automatically liquidate it to ensure the lender's supplied assets are protected. It's a system designed to operate without a loan officer or a credit check, relying instead on over-collateralization and automated code. 3. Oracles. A major challenge for smart contracts is that they are sealed systems. They cannot access data from the outside world on their own, but many financial applications need real-world information, like the current price of a digital asset or the price of the US dollar. This is where oracles come in. Oracles are third-party services that act as a bridge, securely feeding external, real-world data to the smart contracts on the blockchain. They are a critical piece of infrastructure that allows DeFi protocols to interact with off-chain information. The guiding principles of DeFi. Beyond the specific applications, DeFi is guided by a few key principles. Accessibility. DeFi applications are generally open and permissionless. Anyone with an internet connection and a digital wallet can access them, regardless of their location or financial status. Transparency. Because all transactions and the smart contract code itself are on a public blockchain, they are open for anyone to view and audit. This creates a high degree of transparency compared to the often opaque nature of traditional financial systems. User control. In DeFi, the user maintains self-custody of their assets. There is no central entity that can freeze your account or reverse a transaction. This grants a high degree of autonomy, but also comes with a high degree of personal responsibility. It's crucial to understand that DeFi is still in its early stages of development. It faces significant challenges, including smart contract security risks, scalability issues, and an evolving regulatory landscape. The technology is complex, and interacting with it requires a deep understanding of the associated risks. In summary, DeFi is an attempt to build a parallel, open-source financial system on the blockchain using smart contracts to replace traditional intermediaries. Its building blocks, like decentralized exchanges and lending protocols, aim to create more accessible and transparent financial services. In our next chapter, we will shift our focus to the different flavors of blockchain and explore some of the major platforms beyond Bitcoin, such as Ethereum, which made much of the DeFi and NFT innovation possible. Thank you for joining me for this overview of a complex and fascinating space. Hello and welcome back. So far in our series, we've talked about blockchains, transactions, smart contracts, NFTs, and DeFi. We've often discussed these concepts in a general sense, but the reality is that not all blockchains are built the same way or for the same purpose. Today we're going to look at the two most significant and foundational public blockchains, Bitcoin and Ethereum. Understanding their distinct goals and technological differences is key to understanding the entire landscape. As we discuss these specific platforms, it is absolutely essential to reinforce our educational mission. This chapter is a technical and conceptual comparison, not an investment analysis. We will not discuss price, market performance, or whether one is better than the other from a financial perspective. The information provided is for educational purposes only. Any decisions regarding digital assets should be made in consultation with a qualified, licensed financial professional. Bitcoin, the pioneer of digital scarcity. Bitcoin, launched in 2009 by the pseudonymous Satoshi Nakamoto, was the very first successful application of blockchain technology. Its purpose, as outlined in the original white paper, was to be a peer-to-peer electronic cash system. It was designed to solve one primary problem: how to create a secure, decentralized, and scarce digital currency that doesn't rely on any intermediary like a bank or government. The core innovation of the Bitcoin blockchain is its ability to maintain a trustworthy ledger of transactions. Its design philosophy prioritizes security, stability, and decentralization above all else. The ledger. The Bitcoin blockchain is best understood as a highly specialized and relatively simple ledger. Its main function is to track the ownership of its native asset, Bitcoin BTC. Each transaction is essentially an entry in this global digital checkbook. Scripting language. Bitcoin does have a scripting language, but it is intentionally limited. It's designed to handle basic transactional logic, such as verifying digital signatures and ensuring a user has enough funds to make a payment. It was not designed to be a platform for building complex applications. Block time and supply. The protocol is engineered for predictability. A new block is added to the Bitcoin blockchain approximately every 10 minutes. Furthermore, the total supply of Bitcoin is capped at 21 million. This hard cap is written into the code and is a fundamental feature, designed to create digital scarcity, much like a precious metal like gold. Consensus. Bitcoin uses the proof-of-work consensus mechanism, which we discussed in Chapter 2. This method, while energy-intensive, has proven to be incredibly robust over more than a decade, securing the network against attacks. Think of Bitcoin as the first-generation blockchain. Its purpose is focused and clear: to be a secure, decentralized store and transfer of value. Its simplicity is a feature, not a bug, contributing to its unparalleled security and resilience. Ethereum, the world computer. If Bitcoin was the first chapter in the blockchain story, Ethereum, launched in 2015, was the second, and it introduced a radical new plot twist. Ethereum's creator, Vitalik Buterin, saw the potential of blockchain technology beyond just a payment system. He envisioned a global, decentralized computer that could run any application imaginable. While Ethereum also has a native digital asset, ETH, which is used to pay for computations on the network, the true innovation of Ethereum is its programmability. The ledger. The Ethereum ledger is far more complex than Bitcoin's. It doesn't just track account balances, it also tracks the state of countless applications and smart contracts. It's less like a checkbook and more like the hard drive of a shared global computer. Smart contracts. This is the key differentiator. Ethereum introduced a flexible, Turing-complete programming language, most notably Solidity. This allows developers to write and deploy sophisticated smart contracts that can execute any logic they can dream up. The concepts we explored in our chapters on NFTs and DeFi were almost all pioneered and built on the Ethereum blockchain because of this capability. Block time and supply. Ethereum's design prioritizes speed and flexibility for its applications. Its block time is much faster, around 12 to 15 seconds, allowing for quicker transaction confirmations. Unlike Bitcoin, Ether's supply is not hard-capped, though its issuance rate has been significantly reduced through network upgrades. Consensus. For many years, Ethereum also used proof of work. However, in a major technological shift known as the merge, it transitioned to a proof-of-stake consensus mechanism. This was done to dramatically reduce the network's energy consumption and to change the way the network is secured, from computational power to economic collateral. We will explore proof-of-stake in more detail in a future chapter. Think of Ethereum as a second-generation blockchain. It took the core idea of a decentralized ledger and transformed it into a programmable platform. It's a foundation for developers to build on, which has led to a massive ecosystem of decentralized applications, or dApps. A tale of two philosophies. In essence, Bitcoin and Ethereum were created to do two very different things. Bitcoin is designed to be digital gold. It aims to be the most secure and reliable store of value in the digital world. Its development is slow and cautious, with an emphasis on maintaining its core properties of scarcity and security. Ethereum is designed to be a decentralized world computer. It aims to be a versatile platform for a new generation of the internet, often called Web 3. Its development is dynamic and focused on scalability, enabling a vast range of applications from finance to gaming to digital identity. They are not necessarily competitors. Rather, they are the two foundational pillars of the public blockchain ecosystem, each representing a different vision for what this technology can achieve. Understanding the distinction between Bitcoin's role as a store of value and Ethereum's role as a smart contract platform is crucial for navigating any further exploration of this space. In our next chapter, we will discuss the concept of scalability and the so-called blockchain trilemma, which will help us understand the challenges these platforms face and the solutions being developed to overcome them. Thank you for joining me for this foundational comparison. Hello and welcome back. In our last chapter, we compared the two giants of the blockchain world, Bitcoin and Ethereum, and saw how they were designed with very different goals in mind. One as a secure store of value, the other as a world computer. This contrast highlights a fundamental challenge that nearly every public blockchain faces. It's a concept so central to the field that it has its own name, the blockchain trilemma. Understanding this trilemma is the key to appreciating why blockchain technology is still evolving and why new solutions are constantly being developed. As always, we begin with our important reminder. This discussion is purely technical and conceptual. It is designed for educational purposes only, and is not a guide for making financial decisions. We will not be discussing the investment potential of any technology mentioned. For any financial, legal, or tax-related questions, please seek advice from a licensed professional. What is the blockchain trilemma? The term blockchain trilemma was famously coined by Ethereum's co-founder, Vitalik Buterin. It describes the difficulty that decentralized networks have in simultaneously achieving three core properties. Decentralization. This is the foundational property we've discussed throughout this series. It means there is no central point of control. The network is maintained by a distributed group of participants, making it censorship-resistant and democratic. Security. This refers to the network's ability to defend itself from attacks. A secure blockchain has a very high cost of attack, meaning a malicious actor would need to expend an enormous amount of resources to successfully alter the ledger or halt its operations. On a large public blockchain like Bitcoin, this is achieved through the combined computational power of all its miners. Scalability. This is the network's ability to process a large volume of transactions quickly and affordably. Scalability is often measured in transactions per second, or TPS. For blockchain technology to be used by millions or even billions of people for everyday applications, it needs to be able to handle a throughput comparable to traditional payment networks like Visa, which can process thousands of transactions per second. The trilemma suggests that it is incredibly difficult to maximize all three of these properties at the same time. A blockchain can typically pick two, but only at the expense of the third. For example, Bitcoin and Ethereum were designed to be highly decentralized and highly secure. To achieve this, every node on the network has to process every single transaction. This distributed consensus provides immense security, but it creates a bottleneck. The network can only process transactions as fast as its individual nodes can agree on them, which results in low scalability. This is why, during times of high demand, these networks can become congested, leading to slow confirmation times and high transaction fees. Conversely, you could create a blockchain with very high scalability and security by reducing its decentralization. For instance, you could run the network on just a handful of very powerful, trusted servers. This would be incredibly fast, but it would no longer be a truly decentralized blockchain. It would be a centralized system, vulnerable to censorship and control by the few entities running those servers. The quest for scalability, Layer 1 and Layer 2 solutions. Solving the blockchain trilemma is one of the most significant areas of research and development in the entire industry. The efforts to improve scalability generally fall into two broad categories: Layer 1 and Layer 2 solutions. Layer 1 scaling. A Layer 1 solution is any change that alters the core protocol of the blockchain itself to improve its capacity. One such example is the move from proof of work to proof of stake, which Ethereum undertook. Another Layer 1 technique being explored is sharding. In a sharded blockchain, the network's database is split into smaller, more manageable pieces called shards. Instead of every node having to process every transaction in the entire network, nodes can be assigned to a specific shard and are only responsible for processing the transactions within it. This parallel processing allows the network to handle many more transactions simultaneously, significantly improving scalability. It's like taking a single congested highway and splitting it into multiple parallel lanes. Layer 2 scaling. If a Layer 1 solution changes the highway itself, a Layer 2 solution builds an express lane on top of it. Layer 2s are separate protocols built on top of an existing blockchain, the Layer 1. Their goal is to handle the bulk of transactions off the main chain, using the main chain only for final settlement and security. This frees up the Layer 1 to do what it does best: provide ultimate security and decentralization. One of the most popular types of Layer 2 solutions is called a rollup. A rollup works by bundling or rolling up hundreds or even thousands of transactions together into a single batch. This batch is processed off-chain on the Layer 2 network. The rollup then generates a compressed summary of the results and submits just that single piece of data back to the main Layer 1 blockchain. By doing this, the network gets the best of both worlds. The computational heavy lifting is done on the fast and cheap Layer 2, but the final record is still secured by the robust, decentralized Layer 1. This dramatically increases the number of transactions the ecosystem can handle without sacrificing the security of the main chain. There are different types of rollups, such as optimistic rollups and zero-knowledge (ZK) rollups, which use different cryptographic methods to prove the validity of their off-chain transactions. While the technical details differ, their shared goal is to make blockchain networks faster and more affordable for everyday users. In conclusion, the blockchain trilemma describes the constant trade-off between decentralization, security, and scalability. While foundational blockchains like Bitcoin and Ethereum optimize for the first two, an entire industry of innovation is now focused on solving the scalability piece. Layer 1 improvements like sharding and Layer 2 solutions like rollups are paving the way for blockchain networks that can support a new generation of applications at a global scale. In our next chapter, we will take a closer look at the different types of consensus mechanisms, moving beyond proof of work to understand how proof of stake and other models function. Thank you for joining me for this important discussion on the challenges and future of blockchain scalability. Hello and welcome back. In our previous chapters, we've repeatedly mentioned that blockchains are decentralized systems that need a way for all participants to agree on the true state of the ledger. This system of agreement is called a consensus mechanism. It is the rulebook that governs how new blocks are added to the chain, ensuring that every transaction is valid and that everyone's copy of the ledger remains identical. The first and most famous of these mechanisms is proof of work, which we introduced when discussing Bitcoin. But it's not the only way to achieve consensus. Today we will explore the mechanics and philosophies behind the two dominant models: proof of work and its leading alternative, proof of stake. As we delve into these core technical components, our guiding principle remains firm. This content is for educational and informational purposes only. We are analyzing computer science concepts, not financial assets. This is not investment, legal, or financial advice. The objective is to understand how these systems function, not to evaluate their potential as investments. For such guidance, please consult a licensed professional. A quick recap: proof of work, POW. Let's briefly revisit proof of work. As we discussed, POW systems rely on participants called miners who use powerful computers to compete. They are all racing to solve a complex mathematical puzzle. The first miner to find the solution gets to propose the next block of transactions and is rewarded with a certain amount of the network's native currency. The work is the immense computational effort required to guess the answer to the puzzle. This process, known as mining, is what consumes a significant amount of electricity. The security of a POW network comes from the cost of this work. To attack the network and rewrite the transaction history, a malicious actor would need to control more than 50% of the entire network's computational power, a 51% attack. For a large network like Bitcoin, acquiring that much specialized hardware and electricity would be astronomically expensive, making the network very secure. For years, proof of work was the undisputed standard for securing a public blockchain. However, its high energy consumption and the trend toward industrial-scale mining operations led researchers to develop a different approach. The alternative, proof-of-stake (POS). Proof-of-stake is a different type of consensus mechanism that aims to achieve the same goal, securing the network and verifying transactions, but through a completely different method. Instead of miners performing computational work, a proof-of-stake network relies on participants called validators. Instead of contributing computing power, validators lock up, or stake, a certain amount of the network's native cryptocurrency as collateral. The stake is an economic bond to the network. By staking their own digital assets, validators are making a financial commitment to act honestly. If they validate fraudulent transactions or try to attack the network, the protocol can automatically destroy, or slash, a portion of their staked collateral as a penalty. The process. In a POS system, the protocol chooses a validator to propose the next block. This selection process is typically pseudo-random, but it's often weighted. The more you stake, the higher your chance of being chosen to create a block and earn the associated rewards. Once a block is proposed, other validators attest to its validity. If enough validators agree, the block is added to the chain. The security of a POS network comes from this economic incentive. To attack the network, a malicious actor would need to acquire and stake a huge amount of the native currency, at least 51% in most designs. Not only would this be incredibly expensive, but if they were to then attack the network, the resulting chaos and loss of trust would likely cause the value of the very asset they hold to collapse, making the attack economically self-destructive. You can think of the difference with this analogy. In proof of work, you secure the network by proving you have spent resources, electricity, in the real world. In proof of stake, you secure the network by proving you have a significant economic investment in the network's success. Key differences and trade-offs. The shift from POW to POS, most notably undertaken by Ethereum, is driven by several key differences. 1. Energy consumption. This is the most significant distinction, because proof of stake eliminates the need for a massive, energy-intensive computational race. It is vastly more energy efficient. It replaces computational work with capital lockup, reducing the network's energy footprint by orders of magnitude. 2. Accessibility. The arguments here are nuanced. With POW, anyone can theoretically buy a mining rig and start competing. However, it has evolved into a highly specialized industry dominated by large corporations with access to cheap electricity. With POS, anyone who owns the native token can participate by staking. This can lower the hardware barrier to entry, but it also raises concerns that wealthy participants who can stake more will earn more rewards, potentially leading to a concentration of influence. Many protocols address this through delegated staking, where users can pool their stake with a larger validator. 3. Economic security. Both models have proven to be robust, but they operate on different principles. POW security is based on external hardware and energy costs. POS security is based on the internal value of the staked asset. The debate over which model is ultimately more secure is a complex and ongoing topic among computer scientists and cryptographers. It's also worth noting that innovation in this area hasn't stopped. Researchers are constantly exploring hybrid models and entirely new consensus mechanisms, such as delegated proof of stake, DPS, and proof of history, POH, each with its own unique set of trade-offs. In summary, consensus mechanisms are the engines that allow decentralized networks to function. Proof of work secures the network through computational power, while proof of stake secures it through economic collateral. The move toward proof of stake is largely driven by a desire for greater energy efficiency and scalability, representing one of the most significant evolutions in blockchain technology. In our next chapter, we will turn our attention to personal security. We'll discuss digital wallets, how to manage your private keys, and the best practices for safely interacting with blockchain applications. Thank you for joining me for this deep dive into blockchain consensus.
The information presented in this video is for informational and educational purposes only, and is not professional financial, investment, or tax advice. All cryptocurrency investments involve risk, and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. Cryptocurrency investments are highly volatile and speculative. This video does not recommend investing in any specific cryptocurrency. Always do your own research and assess the risks before making any investment decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
Hello and welcome back. Throughout this series, we have explored the grand architecture of blockchain technology, from decentralized ledgers to complex consensus mechanisms. Today we bring the focus down to the most personal and critical component of interacting with any blockchain: the digital wallet. Understanding what a wallet is, what it holds, and the principles of keeping it secure is fundamental for anyone engaging with this technology. This chapter will discuss security concepts and best practices from a purely educational standpoint. It must be stated clearly that this is not personal security advice, financial advice, or a recommendation for any specific product. The responsibility for securing digital assets lies solely with the individual. The purpose of this chapter is to provide the foundational knowledge you need to understand that responsibility. Always perform your own thorough research. What is a digital wallet? First, let's clear up a common misconception. A blockchain wallet does not actually store your digital assets. Your assets, like a cryptocurrency or an NFT, always exist on the blockchain itself. They are entries on that global, distributed ledger. A digital wallet is better understood as a keychain. It is a piece of software or hardware that manages your keys, your public keys, and most importantly, your private keys. These keys are what allow you to access and control your assets on the blockchain. Public key, as we've mentioned before, this is like your bank account number. You can share it freely with others so they can send assets to you. Your public address, which you use to receive funds, is a shortened, more convenient version of your public key. Private key. This is the secret password to your funds. It is a long, complex string of cryptographic data that gives you the authority to sign and approve transactions from your address. Whoever controls the private key controls the assets associated with it. Sharing your private key is like giving someone the signed, blank check to your entire bank account. It should never be shared with anyone, for any reason. The core principle of a self-custody wallet is simple but profound. Not your keys, not your assets. If you use a service where you don't hold the private keys, you are trusting that third party to secure your assets for you. When you use a self-custody wallet, you have full control, and with that comes full responsibility. The master key, your seed phrase. When you first set up most modern wallets, you will be presented with something called a seed phrase, also known as a recovery phrase or mnemonic phrase. This is typically a list of 12 to 24 simple words, presented in a specific order. This is the single most important piece of information you will receive. Your seed phrase is the master key to your entire wallet. From this single phrase, every private key and public address your wallet ever generates can be mathematically derived. If your computer crashes or your phone is lost, you can download a new wallet, enter your seed phrase, and you will regain access to all of your assets. Conversely, if anyone else gets access to your seed phrase, they can do the same. They can import your wallet onto their own device, and will have complete control to drain all of your funds. Therefore, the way you secure your seed phrase is the foundation of your personal security in the blockchain world. The standard best practice is to write it down on a piece of paper, or on a more durable material like steel, and store it in a secure, private, offline location. Storing it digitally, in a text file on your computer, in an email, or as a photo on your phone, is strongly discouraged, as anything connected to the internet is a potential target for hackers. Hot wallets versus cold wallets. Wallets generally fall into two main categories, based on whether or not they are connected to the internet. 1. Hot wallets. A hot wallet is any wallet that is connected to the internet. This includes software wallets. These are applications you install on your computer or phone. Web wallets. These run in your web browser, often as an extension. Hot wallets are convenient for everyday use. They make it easy to send, receive, and interact with decentralized applications. However, this constant internet connection also makes them more vulnerable to online attacks, malware, and phishing scams. They are best used for holding smaller amounts of digital assets that you might need for frequent transactions, similar to how you might carry a small amount of cash in a physical wallet. 2. Cold wallets, cold storage. A cold wallet is a device or method that keeps your private keys completely offline. The two most common types are hardware wallets. These are small physical devices, often resembling a USB stick. They are specifically designed to store your private keys in a secure, offline environment. When you want to make a transaction, you connect the device to your computer, and the transaction is signed internally on the device itself. The private key never leaves the hardware wallet and is never exposed to the internet-connected computer. Paper wallets. This is a method where your public and private keys are printed out, perhaps as a QR code, on a piece of paper and stored securely. This method is less common now due to its complexities and the risk of physical damage. Cold storage is widely considered the most secure way to hold a significant amount of digital assets for the long term, much like putting your valuables in a secure bank vault. In summary, personal security in the blockchain space revolves around the careful management of your private keys. Your wallet is your keychain, and your seed phrase is the master key that can restore it. Understanding the difference between convenient, but more vulnerable hot wallets and secure, but less convenient cold wallets allows you to make informed decisions about how to manage your digital assets responsibly. In our next chapter, we will explore the wider ecosystem, looking at the concepts of Web3 and the idea of a decentralized internet. Thank you for joining me for this crucial discussion on personal security. Hello and welcome back. In our journey so far, we have assembled the key building blocks of a new technological paradigm. Decentralized networks, smart contracts that automate agreements, and digital wallets that give users control over their own assets. Today, we're going to put those pieces together to explore the broader vision they collectively aim to build. That vision is called Web3. This chapter explores a forward-looking concept, a philosophy for the next generation of the internet. As we discuss this evolving idea, our foundational rule remains in place. This is for educational and informational purposes only. It is not a recommendation to invest in any technology, nor is it financial, legal, or any other form of professional advice. Our goal is to understand the concepts and the conversation around them. To understand Web3, we must first understand Web 1 and Web 2. The term Web3 implies there was a Web 1 and a Web 2. Understanding this evolution is the clearest way to grasp what Web3 aims to be. Web 1 was the read-only web, roughly 1990 to 2004. Think of the earliest days of the internet. Websites were mostly static pages of information, like digital brochures or articles. They were built by a small number of creators, and the vast majority of users were simply passive consumers of that content. You could read, but you couldn't easily contribute. The experience was largely one-way, and the protocols that powered it, like HTTP and SMTP, were open and decentralized. Web 2 is the read-write web, roughly 2004 present. Web 2 is the internet we know and use every day. It's dynamic, interactive, and social. The rise of social media platforms, blogs, and e-commerce giants transformed users from passive consumers into active creators. We can now write, publish, share, and interact with content and each other with incredible ease. This explosion of user-generated content was made possible by centralized platforms. Companies like Google, Meta, Amazon, and Twitter built the sophisticated applications and infrastructure that allowed billions of people to participate. In doing so, they provided immense value, but this model came with a trade-off. In Web 2, the platform is the intermediary. The platform owns the infrastructure, sets the rules, and most importantly, controls the data. Our content, our social connections, and our data profiles are stored on their servers and are governed by their terms of service. Web 3. The read-write-own web. Web 3 is a vision for the next era of the internet that aims to combine the decentralized ethos of Web 1 with the rich, interactive experience of Web 2. The defining characteristic of Web 3 is ownership. If Web 1 was read-only, and Web 2 is read-write, then Web 3 is envisioned as read-write-own. The core idea is to build an internet where users, not centralized corporations, are in control. It seeks to replace the centralized applications of Web 2 with decentralized applications, or dApps, that run on public blockchains. In this model, the network itself, rather than a single company, becomes the platform. Let's look at the key pillars that enable this vision. 1. Decentralized infrastructure. Instead of applications running on servers owned by one company, Web3 applications are built on peer-to-peer networks like Ethereum. The rules are enforced by smart contracts, and the data is stored on the blockchain, making it transparent and censorship-resistant. 2. User-owned data and identity. In Web3, your identity is tied to your digital wallet, which we discussed in the last chapter. Your wallet address becomes your universal login for this new web. You control the keys, so you control your identity. You can interact with applications without creating dozens of separate accounts and handing over your personal information to each one. You decide what data to share and with whom. 3. Native digital ownership. Using technologies like NFTs, ownership is baked into the internet at a foundational level. When a creator makes a piece of digital art, or a gamer earns a unique item, they can truly own it as a verifiable asset on the blockchain. This allows for new economic models where creators can engage directly with their audience without a platform taking a large cut or dictating the terms. What could Web3 look like? This is not just a theoretical concept. Developers are actively building applications based on these principles. For example, decentralized social networks. Imagine a social platform where you own your profile and your list of connections. You could move from one app to another, taking your social graph with you, and your content couldn't be unilaterally removed by a central authority. Decentralized storage. Instead of uploading your files to Google Drive or Dropbox, you could use a service that encrypts your files and distributes them across a global network of computers. You would hold the only key, ensuring your privacy and control. Creator economies. Musicians could sell their music directly to fans as NFTs, with smart contracts automatically handling royalty payments every time the song is played or resold. It is critical to state that Web3 is still a vision in progress, not a fully realized reality. It faces significant challenges. The user experience can be complex for newcomers, scalability is an ongoing issue as we've discussed, and the regulatory landscape is still uncertain. The transition from the internet we know today will be gradual, if it happens at all on a mass scale. In summary, Web3 represents a fundamental shift in the philosophy of the internet. A move away from a centralized, platform-dominated model to a decentralized ecosystem where users have verifiable ownership and control over their data and digital assets. It leverages blockchain, smart contracts, and digital wallets to create a new foundation for the web. In our next chapter, we will explore a practical example of Web3 governance in action by looking at decentralized autonomous organizations, or DAOs. Thank you for joining me to explore this forward-looking vision for the internet. Hello and welcome back. In our last chapter, we explored the grand vision of Web3, a new internet built on the principles of decentralization and user ownership. A key question that arises from this vision is, if we decentralize technology, how do we organize and govern ourselves within these new digital ecosystems? This leads us to one of the most innovative and experimental concepts in the blockchain space, the Decentralized Autonomous Organization, or DAO. Before we unpack this complex topic, we must restate our foundational commitment. This chapter is for educational purposes only. We are exploring a new model for organizational structure, not providing any form of financial, legal, or investment advice. DAOs are a nascent and highly experimental area. The sole purpose of this discussion is to understand the technology and the concept. What is a DAO? To understand a DAO, let's first think about a traditional organization, like a company or a nonprofit. These organizations have a hierarchical structure. There's a CEO or a board of directors at the top who make the critical decisions. The rules of the organization are often recorded in legal documents, and actions are carried out by human employees. This structure relies on trust in the leadership and the legal system to enforce the rules. A DAO turns this model on its head. It is a community-led entity with no central leadership. You can think of it as an internet-native organization. Instead of a hierarchy, a DAO is flat. Instead of relying on a CEO, it relies on its members. And instead of legal documents, its rules are written in code. Let's break down the name. Decentralized. There is no single person or group in charge. Control is distributed among all the members of the organization. Autonomous. Once the core rules are deployed as smart contracts on a blockchain, the organization can operate on its own, automatically executing decisions when certain conditions are met, without the need for human intermediaries. Organization. It is a group of people coordinating and collaborating around a shared mission or goal. In essence, a DAO is a group of people who agree to be bound by a set of rules that are automatically enforced by smart contracts on a blockchain. How does a DAO work? A DAO's operations are typically built around three core components. 1. Smart contracts. These form the foundation of the DAO. The initial creators write the governance framework, the constitution of the organization, into a set of smart contracts. These contracts define the DAO's purpose, how to manage its treasury, how voting works, and what actions can be taken. Because these rules are on a public blockchain, they are completely transparent for anyone to see and audit. 2. Governance tokens. To become a member and have a say in the DAO's decisions, one usually needs to hold the organization's specific governance token. Typically, the more tokens a member holds, the more voting power they have. This token-based model is the most common way to align the incentives of the members with the success of the organization. 3. Proposals and voting. The entire decision-making process is done through proposals. Any member, often depending on holding a minimum number of tokens, can submit a proposal for the group to vote on. A proposal could be anything: a suggestion to fund a new project from the community treasury, a change to the DAO's governance rules, or a decision to hire a contributor. The members then vote on the proposal using their governance tokens. If the proposal reaches a predetermined level of consensus, a quorum, the decision is finalized. If the proposal involves an action like sending funds, the smart contract will execute it automatically and trustlessly. Potential use cases for DAOs. The DAO structure is a flexible framework that can be applied to many different types of organizations. Conceptually, they could be used for community treasuries. Many DeFi protocols are governed by DAOs. The holders of the protocol's governance token can vote on the future direction of the project, such as how to allocate fees collected by the protocol. Collector groups. A group of people could pool their funds into a DAO's treasury to collectively purchase high-value assets, like a rare NFT. The members would then vote on how to manage that asset. Social clubs. An online community could form a DAO to manage its membership and activities, with members voting on community rules and events. Charities and grants. A philanthropic DAO could allow members to vote directly on which projects or causes receive funding from the treasury, creating a transparent and community-driven approach to giving. Challenges and considerations. While the concept is powerful, DAOs are still very much in their experimental phase and face significant challenges. Governance. Token-based voting can lead to a situation where a few large token holders, often called whales, have an outsized influence, which can run counter to the goal of decentralization. Efficiency. Reaching consensus through community-wide voting can be slow and inefficient, especially for making rapid day-to-day decisions. Security. The smart contracts that run a DAO must be impeccably written. A bug or exploit in the code could put the entire organization's treasury at risk. Legal uncertainty. DAOs operate in a legal gray area. Their status as legal entities is not well defined in most jurisdictions, which creates uncertainty about liability and accountability. In summary, a DAO is a novel way of organizing human collaboration using blockchain technology. It replaces traditional hierarchical structures with a transparent, democratic, and automated system governed by smart contracts and the collective will of its members. While they face many challenges, they represent a practical and fascinating experiment in the future of governance and organization in a digital world. In our next chapter, we will address the important and complex topic of the regulatory landscape for blockchain and digital assets in the United States. Thank you for joining me to learn about this new form of organization. Hello and welcome back. In our journey, we've explored the technology, the applications, and the philosophy behind blockchain. But all innovation eventually intersects with the real world and its existing structures. Today, we will address a topic that is complex, constantly evolving, and critically important: the regulatory landscape for digital assets in the United States. It is imperative to begin this specific chapter with our most serious reminder. The following discussion is a high-level, educational overview and is absolutely not legal, financial, or tax advice. The regulatory environment is highly complex and subject to change. The sole purpose of this chapter is to describe the general state of affairs and introduce the main participants. For any personal or business decisions, it is essential to consult with qualified, licensed legal and financial professionals. Why is regulation a topic of discussion? First, it's helpful to understand why government agencies are focused on this space. From their perspective, the goals are generally consistent with their mandates in traditional finance: consumer and investor protection, to ensure that individuals are protected from fraud, manipulation, and undue risk; financial stability, to prevent new technologies from disrupting the stability of the broader financial system; preventing illicit activity, to combat money laundering, terrorist financing, and other financial crimes, in line with established global standards. The primary challenge for regulators is applying rules that were written for a centralized financial world to a new, decentralized technological paradigm. This has led to an approach that involves multiple agencies, each looking at the technology through its own specific lens. The key agencies involved. In the United States, there isn't one single crypto regulator. Instead, a number of different agencies have asserted jurisdiction, creating a complex and sometimes overlapping patchwork of oversight. 1. The Securities and Exchange Commission (SEC). The SEC's mission is to protect investors and regulate the securities markets. A key question for the SEC is whether a particular digital asset qualifies as a security. The primary framework used for this determination is the Howey test, which comes from a 1946 Supreme Court case. In simple terms, the test considers an asset a security if it involves an investment of money in a common enterprise with a reasonable expectation of profit to be derived from the efforts of others. If a digital asset meets this definition, the SEC considers it a security, and it would fall under their jurisdiction, subject to disclosure and registration requirements. 2. The Commodity Futures Trading Commission, CFTC. The CFTC oversees the derivatives markets in the U.S., including futures and options contracts for commodities like oil, gold, and agricultural products. The CFTC has publicly stated that it views certain digital assets, most notably Bitcoin, as commodities. Therefore, its primary role in the space is regulating the trading of crypto-based derivatives, such as Bitcoin futures contracts on regulated exchanges. 3. The Department of the Treasury. Several branches of the Treasury Department are involved. The Internal Revenue Service, IRS. For tax purposes, the IRS has issued guidance stating that it treats virtual currencies as property, not as currency. This means that when you sell, trade, or in some cases use digital assets, it can be a taxable event, potentially subject to capital gains or losses, just like selling a stock or a piece of property. The Financial Crimes Enforcement Network, FinCEN. Mission is to combat financial crime. FinCEN applies the Bank Secrecy Act to the digital asset world, requiring cryptocurrency exchanges and other money services businesses to implement anti-money laundering, AML, and Know Your Customer, KYC, programs to report suspicious activity. Major regulatory themes. Rather than memorizing specific rules, it is more helpful to understand the broad themes that are the focus of ongoing discussion and debate in the United States. Asset classification. The central question remains: are most digital assets securities, commodities, or something else entirely? The answer has significant implications for how they are regulated, and the debate between the SEC and CFTC is a key part of this conversation. Stablecoins. There is a strong regulatory focus on stablecoins, which are digital assets designed to maintain a stable value. Lawmakers and regulators are examining how to ensure these coins are fully backed by high-quality reserves, and that holders can always redeem them for their equivalent value. DeFi and DAOs. Decentralized finance and decentralized autonomous organizations present a unique challenge. How do you apply regulations designed for identifiable, centralized companies to autonomous smart contracts and globally distributed communities? This is a frontier question that regulators are still grappling with. Market integrity. A consistent goal across all agencies is to ensure fair markets. This involves creating rules to prevent fraud, market manipulation, and insider trading, just as in traditional financial markets. In summary, the U.S. regulatory approach to blockchain and digital assets is not monolithic. It is a multi-agency effort that is still in the process of defining itself. The landscape is dynamic, with ongoing discussions among lawmakers and regulators about how to craft a comprehensive framework for the future. Staying informed through official government sources is a key principle for any participant in this ecosystem. In our next chapter, we will move beyond the financial and legal aspects to discuss the broader societal implications of this technology. Thank you for joining me for this important and complex topic. Hello and welcome back. Over the course of this series, we have journeyed deep into the mechanics of blockchain technology, from its basic structure to its most advanced applications, and its interaction with the regulatory world. For this chapter, we are going to pull back from the code and the markets to ask a different set of questions. What are the broader societal and ethical implications of this technology? What kind of world might it help create, and what new challenges might it present? This is a philosophical discussion, designed to encourage critical thinking. As such, it is purely for educational and informational purposes. The ideas presented here are subjects of ongoing debate among technologists, sociologists, and policymakers. We will be exploring questions, not providing answers or taking a definitive stance on any issue. The double-edged sword of decentralization. At the heart of the blockchain ethos is decentralization. The promise is a shift of power away from central intermediaries, be they banks, tech giants, or governments, and toward individuals and distributed communities. The potential upside. Proponents argue that this could lead to a more equitable and resilient society. It could empower individuals in places with unstable institutions by giving them direct control over their assets. It could enable creators to connect with their audiences without censorship or unfair monetization from a central platform. In theory, decentralization fosters systems that are more resistant to single points of failure and control. The ethical questions. However, this same quality presents profound challenges. If a platform is truly decentralized, Who is accountable when things go wrong? How does a society address harmful or illegal content on a censorship-resistant network? While removing powerful intermediaries can be liberating, it can also remove the very entities that provide user protection, dispute resolution, and a clear line of accountability. This creates a tension between individual freedom and collective safety, transparency versus privacy. Public blockchains operate on a principle of radical transparency. Every transaction is recorded on an open ledger for anyone to see. The potential upside. This creates a new paradigm for auditing and accountability. Imagine a charity where every single donation and expenditure is visible on a public blockchain, ensuring funds are not misused. Consider a supply chain where consumers can trace the exact origin of their products, verifying ethical sourcing. This level of transparency has the potential to build immense trust in systems. The ethical questions. The flip side of total transparency is the potential erosion of privacy. While your real name might not be on the ledger, your pseudonymous wallet address is. Over time, patterns of transactions can be analyzed to de-anonymize users. This raises critical questions. Is it desirable for all financial activity to be public? What are the societal implications of a world where every transaction is a permanent, public record? Balancing the benefits of transparency with the fundamental right to privacy is one of the most significant ethical hurdles for this technology to overcome. Innovations in cryptography, like zero-knowledge proofs, are being developed to address this, but the debate continues. Code is law. Automation and its limits. A core principle in many blockchain communities, especially in DeFi and DAOs, is the idea that code is law. This means that the rules embedded in a smart contract are the final arbiter of any dispute. The code executes exactly as it is written, automatically and impartially. The potential upside. This offers the promise of perfectly predictable and neutral systems. Agreements are enforced without the potential for human bias, error, or corruption. If the conditions of the code are met, the action occurs. This can create highly efficient and fair systems where everyone is subject to the exact same rules. The ethical questions. The challenge is that human affairs are often messy, nuanced, and require context that code cannot understand. What happens if there is an unforeseen bug in the smart contract's code that leads to a catastrophic loss of funds? If code is law, does that mean the loss is irreversible, even if it was unintentional? Traditional legal systems are designed to be flexible and to interpret the spirit, not just the letter, of the law. An over-reliance on rigid, automated code could lead to outcomes that are technically correct but ethically unjust. This raises the question of how to build systems that are both automated and humane. The digital divide. Finally, as with any powerful new technology, there is the question of access. For all the talk of banking the unbanked, using blockchain technology today still requires a significant level of technical knowledge, access to modern computing devices, and a stable internet connection. This creates the risk of a new digital divide, where the benefits of this technology accrue to those who are already technologically savvy and well-resourced, potentially leaving less privileged communities even further behind. For the vision of a globally inclusive and decentralized future to be realized, addressing issues of user experience, education, and accessibility is not just a design challenge. It is a societal and ethical imperative. In summary, blockchain technology is not merely a new tool. It is a technology that presents us with a new set of societal and ethical trade-offs. The values we embed in these new systems, how we balance freedom with accountability, transparency with privacy, and automation with justice, will shape the impact they have on our world for decades to come. In our final chapter, we will look to the future, summarizing our journey and exploring the long-term vision and ongoing research in the blockchain space. Thank you for joining me for this reflective discussion. Hello, and welcome back for the final chapter in our series on understanding blockchain technology. We have traveled a great distance together. We started with the simple concept of a digital block and ended with the complex ethical questions facing our society. Our goal was to build a foundational understanding, piece by piece, to demystify this transformative technology. As we look toward the future, it's essential to do so with a clear perspective. This final chapter will summarize our journey and explore the concepts and research that are shaping the road ahead. This is a conceptual exploration, not a prediction or a crystal ball. It is, as always, for educational and informational purposes only, and it is not financial or investment advice. The future is unwritten, but by understanding the present, we can better appreciate the direction of travel. A summary of our journey. Let's take a moment to reflect on the key concepts we've covered. we learned that a blockchain is fundamentally a new kind of database, a decentralized, immutable, and transparent ledger that allows for trust between parties without a central intermediary. We dissected the anatomy of a transaction, learning how private keys create digital signatures and how miners or validators bundle these transactions into blocks through consensus mechanisms like proof of work and proof of stake. We saw the technology evolve from Bitcoin's focused goal as digital gold to Ethereum's vision of a world computer, made possible by the innovation of smart contracts, self-executing code that lives on the blockchain. We explored the applications this programmability unlocked, from proving ownership of unique items with NFTs to building an entire parallel financial system with DeFi, and creating new forms of internet-native organizations with DAOs. We confronted the challenges from the blockchain trilemma of balancing security, decentralization, and scalability, to the personal responsibility of securing a digital wallet, to the complex and evolving regulatory and ethical landscapes. This journey has equipped you with the vocabulary and the core concepts to understand the ongoing conversation surrounding this technology. Frontiers of development. What's next? The innovation in the blockchain space is far from over. Researchers and developers are working on several key frontiers to mature the technology and broaden its capabilities. 1. Interoperability, the Internet of Blockchains. Right now, the blockchain world is a bit like a collection of different countries with closed borders. It's difficult for assets or information to move seamlessly from one blockchain, like Ethereum, to another. Interoperability is the effort to solve this. The goal is to create protocols that act as bridges, allowing different blockchains to communicate securely and effectively. The long-term vision is an Internet of Blockchains, a connected ecosystem where users can interact with applications across many different networks without friction. 2. Zero-knowledge proofs, solving the privacy dilemma. We discussed the tension between transparency and privacy. One of the most promising technologies to address this is zero-knowledge proofs, ZKPs. In essence, a ZKP is a cryptographic method that allows one party to prove to another that a statement is true, without revealing any of the underlying information that makes it true. For example, you could prove you are over 21 without revealing your birth date, or prove you have sufficient funds for a transaction without revealing your total account balance. ZKPs are being developed to enable a new generation of applications that are both verifiable and private. 3. Abstraction, making blockchain invisible. For most people, the technical complexity of using blockchains today is a major barrier. The future of the user experience lies in abstraction. The goal is to make the underlying blockchain technology invisible to the end user. Think about how you use the internet today. You don't need to understand the TCP/IP protocol to send an email. Similarly, concepts like account abstraction aim to simplify wallets, eliminate the need to manually manage seed phrases, and make interacting with a dApp feel as simple as using any modern web application. 4. Real-world asset tokenization. A significant trend is the effort to use blockchain technology to represent ownership of tangible, real-world assets. This involves creating a digital token that represents a share of real estate, a piece of fine art, or equity in a private company. The theoretical promise is to make traditionally illiquid assets more divisible, accessible, and easier to trade, potentially bridging the gap between the traditional financial world and the digital ecosystem. A concluding perspective: blockchain technology is not a magic bullet. It is a foundational tool with a specific set of strengths and weaknesses. It is a powerful solution for problems that require decentralization, immutability, and transparency. But for many other problems, a traditional centralized database is still a more efficient and practical choice. The most important takeaway from this entire series is the ability to think critically. The space is filled with both incredible innovation and speculative hype. The knowledge you have gained should serve as a filter, helping you separate the underlying technological substance from the noise. We are still in the very early innings of this technology story, a story that is being written in real time by a global community of developers, thinkers, and builders. The road ahead will undoubtedly involve new breakthroughs, unforeseen challenges, and continued evolution. Thank you for dedicating your time to this journey of learning and discovery. I hope this series has provided you with a clear and solid foundation to continue exploring this fascinating field on your own.
The information presented in this video is for informational and educational purposes only, and is not professional financial, investment, or tax advice. All cryptocurrency investments involve risk, and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. Cryptocurrency investments are highly volatile and speculative. This video does not recommend investing in any specific cryptocurrency. Always do your own research and assess the risks before making any investment decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.